So good morning, everyone. Welcome to today's Wealth Hub session. If you don't know who I am, my name is Ronel Fourie, and for those of you that know me, I was the manager of the previous Efficient Paraplanner Hub, which is in the process of being merged with the Wealth Hub, and I'm also responsible for training our interns to become the future financial advisors in our country. And today I will be talking about death and taxes. I know many of you focus mostly on investments, but before you run away, please stick around because I know the topic of death and taxes tend to make people quite uncomfortable, but we often forget how many opportunities it can open up for an advisor, and also it's quite a personal topic because all of us face death at some point in the future. And when we do these estate plannings in the hub for our advisors, we're often asked, why do you need this information, or why do you need that information? And I agree, we ask for a lot of information, but hopefully this session will help you understand why we ask certain questions. So just give me a second. Okay, so last night, as I was getting ready for bed and saw this video of a little boy called Donnie that played Monopoly with his family, and I wanted to share it because I think for anyone that has ever paid taxes in any form or who is facing paying taxes, they can identify with this little boy.
Oh my gosh.
Where's all your money gone, Donnie?
Taxes. 9, 10, 11. Let me fix my houses.
But it's okay. It's part of the game.
No, it's not.
It
It's
is.
not fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
So just like Donnie, nobody likes paying taxes, but we can try and at least prepare ourselves where possible for what is coming. So today I will briefly discuss what exactly estate planning is, what expenses a person can expect at death, and we will briefly talk about a will, and then also touch on investments at death and where they fit into the picture. When we have a look at where death taxes basically started in South Africa, I was very surprised to learn that it was 158 years ago. So in 1864, it was the beginning of these taxes. But even before we had these taxes at death, humans were faced with the reality of having some form of a funeral. And we can go back about 4,000 years before Christ. Even then, the Egyptians began embalming their dead. And of course, a person's status in life affected how well their bodies were preserved. So if you were royalty like King Tut, you were mummified and entombed in a sarcophagus. And we obviously, luckily, don't do that anymore. But as a human, we have this need to have some form of a ritual to say goodbye. And I'm not sure if you know this, but we are not the only species that have these rituals. You actually see it in the animal kingdom as well. Examples would be like an elephant, crows, chimpanzees, dolphins, and giraffes. But we are the only species that actually pay for these rituals. One of the most popular quotes about death and taxes is one by Benjamin Franklin, and he once said that in this world, nothing can be certain except for death and taxes. And the reality is that it is not cheap to die. So I'm quickly going to just look at the definition of estate planning. And this is Meyerowitz' definition, is the arrangement, management, and securement and disposition of a person's estate to that his family and other beneficiary may enjoy and continue to enjoy the maximum from his estate and his assets during his lifetime and after his death, no matter when death may occur. So if you look at the definition, it actually does not even mention the word estate duty or tax or anything like that. So the main focus is on the enjoyment of the client's assets after death. which can actually only be done if you have a good understanding of the different costs that is involved at death. So I said that we're talking about death and taxes, but it's a bit more complicated than just taxes, because there's a lot of costs involved when a person dies. So when we look at estate planning, we take a lot of things into consideration, like flexibility. We try and pay as little tax as possible. So there's different taxes that's listed here. And we try and avoid causing a tax problem for those that are actually left behind. We want to make sure there's enough liquidity and capital and income for the dependents, and protect the estate against insolvency and inflation, protect any business assets, and succession planning, and then privacy. So I'm sure you are wondering, why is privacy even featuring on this list? Because it's not something that people usually talk about. But on death, your last will and testament is usually read by the family. It's then lodged to the master, and often can become quite a public affair. So particularly among the extended family. So just look around you. This is typical human behavior. The moment somebody dies, all of a sudden, all of these financial dependents will appear and try and claim a portion of the money. So in this instance, we can talk about something like a trust. The trust is far more private, so only beneficiaries of the trust are entitled to the information. And with a trust, there is no winding up on death, and nothing needs to happen. So many people prefer to keep their affairs private and not allow extended family to become aware of what they want. This is quite similar to like when you win the lotto and you don't want your family to know about it, because it's going to probably start a family feud. So just to list a few of the expenses that we look at death, that is what the executor needs in order to wind up the estate. So we're not even looking at things like income for your dependents. So as soon as a person passes away, their deceased estate come into existence, regardless of whether you have a will or not. So the moment you die, they call it a deceased estate. And they need to pay some, you as an individual that died, need to pay certain fees and costs. Well, it's not you that pay it, it's the executor that pays it, but the executor need to wind up your estate, and he can't do it unless certain things are paid. So many people think that when they are dead, it won't matter because they won't be aware of the fact that they are dead. But that is the thing, you end up leaving those that are left behind in this mess. And they need to clean up your mess. So it's important to ensure that your client has a valid will to avoid dying interstate. So if you do not have a will, we say that you are dying interstate. So that's the official term for it. And this basically means there's a certain law that decides who will inherit what. So even if you told your cousins, uncles, nephew, it doesn't matter. If there's no valid will, it does not matter. It's only a valid will that can protect you in this instance. So a lot of the time, the actual assets will not even reach the current heirs or the beneficiaries because there was no valid will in place. And a lot of these assets are not dealt with in a tax efficient way. So here you can see the picture. In this picture, the assets actually just fall to the ground. So all of that can be avoided if one has a valid will in place. And of course, estate planning is crucial to ensure that your clients and their heirs are protected. So you want the correct people to enjoy the benefits that you left behind. And like I mentioned before, it's quite expensive to die, and I'm going to prove this to you in a moment. So firstly, I'm going to talk about funeral cost. There was research done by Sun Life that actually shows that South Africa is one of the most expensive countries to die in when we look at something like funeral cost. We are the 4th most expensive country to die in the world. And on average, it costs about 13% of an average salary to pay for a funeral. In 2020, the average cost of a funeral was about 26,875 Rand. Obviously, it's 2 years ago, so that figure will be even more. So if you have a look at the bar on the left, you will see that we are number 4. Thank goodness we don't live in Japan or China. So to explain how this was actually calculated, they looked at the cost of funeral in the country's currency, and then they compared it with the average salaries in that country. So on average, in practice, what I have seen is funeral policies ranging from 5,000 to 15,000, or at least that, like I said, that is what I have seen. On average, if you look at an entry-level coffin, which sounds like you're buying a car, but for an entry-level coffin, it's 1,000 Rand. But that entry-level coffin is basically a chipboard wooden box. And if you're thinking of something a bit more average, it's about 15,000 for a coffin. And that's just a coffin. There's no other fees that's been paid out of that 15,000 yet. There's no flowers, no food, etc. So now we've dealt with the funeral cost, and the second thing people need to think about is master fees. Most people don't even know this term exists. So the master is someone who works at the High Court, and he or she specifically serves the public in respect of something like deceased estates. So when a person passes away, they have a look at the value of the person's estates. And in the past, it was very easy because if it was just flat out 600 Rand to pay for that master fees. But it became a bit more complicated from the 1st of January 2018 because a sliding scale came into effect. So if you have an estate that is smaller than 250,000, you will pay nothing. For a estate between 250 and 400,000, you will pay 600 Rand. And once that estate is more than 400,000, you will pay 200 Rand for each additional 100,000 above the 400. So it will be the 200 Rands adding up to the 600. The good news at least is that it is capped at 7,000. So you need a gross estate of about 3.6 million in order for you to reach that maximum amount. So when people have physical property like a house, it becomes much more complicated. So people don't realize that by owning property, you have different things that you need to budget for at death. When we see something like a property on the list, that's when we start asking a lot of questions, and there's a reason for that. Like I said, there's a lot of different fees. And one of these are valuation fees. In 2009, there was a board notice that sets out the guidelines for professional fees in terms of how much can be charged to have a property valued at death. So basically, when you pass away, that property needs to be evaluated to determine its value, and you are going to pay that fee even though you are dead. So if you look around an average property of 2 million, you might have to pay about 9,200. For property of 5 million, we're looking at about 13,700. And the fee that you might have to pay can even be more than this specific amount. So another property related expense is a bond cancellation fee. Most people also don't know this. So if the executor is required to cancel the bond because you are no longer alive, you cannot continue to pay the bond. So there will be a bond cancellation. It's the estate at the end of the day that will be liable for that cancellation cost. And this means if you have outstanding debt on the property, you will be penalized for dying, and you will have to pay a bond cancellation fee. And then at death, if an estate owns fixed property, so fixed property is something like a house or a stand. The estate will be required to pay rates and taxes to the municipality 5 months in advance, which is another cost that most people don't even realize exists. If the property had to be sold at death, meaning you don't want to necessarily leave it to your beneficiaries, then you need to pay estate agent commission. And in South Africa, the average rate is, or commission rate is more or less 7.75%. Obviously, that amount is negotiable. And guess who is responsible for this specific commission? The seller of the home, which in this case would be the deceased. And again, for the property, and that's why I'm saying we ask a lot of questions about property, because there's a lot of things that we need to take into account. So if the property is left to a spouse or any other beneficiary, they need to pay something that we call transfer fees. So there's a difference between transfer fees and transfer duty. They are not the same. So the table that you can see on this document will show you how this works. Usually we have a look at the entire value of the property. So if it is a husband and a wife that own the property, we don't just look at the half share of the property. You need to look at the full amount. And based on that, we can determine how much transfer fees more or less the person will have to pay. This excludes VAT, and it also excludes the deeds office levy. So for a property of about 5 million, you are looking at about 53,780 just on transfer cost. Then we also have a deeds office levy. That goes together with the transfer fees, is something that is paid to the deeds office. It's luckily a bit less than the transfer fees, but on a 5 million property, you are still looking at an amount of 2,305. Then just when you thought there could not be any other cost, we have something that we call administration cost. So the executor need to advertise for creditors, and because if you owe money, they need to notify the creditors that you have passed away so that they can actually go and claim the amount that you owe them. So there will be advertising costs. It will depend on the publication that they use. So that can average between 450 and 800 Rand per notice. So that's not, that might not just be a once-off thing. And then postage and petties can be anything between 300 and 500. And then just opening an estate late bank account will cost you on average about 600 Rand in South Africa. Then, of course, the obvious one is the debt in the estates. So a big influence on this is the marital regime. And that would be something like in or out of community of property, with or without accrual. And this is also why we start asking certain questions depending on how the person is married. If we start asking you about the initial accrual, this is one of the reasons, because we use that in the calculation as well. And then one of the biggest traps is capital gain tax, because most people don't necessarily know that this even exists. This means when a person dies, the assets that they have, it is deemed as if the person disposed of it. Basically, they got rid of it. You technically cannot take your possessions with you when you die. Obviously, if you really want, you can be buried with it, but you're still going to pay tax on it. Whether you take it with you or not. And certain assets like property and certain investments can trigger this type of tax. And this obviously don't include things like furniture or your cars. But if a client chooses to leave the assets to his or her spouse, the capital gain can luckily be basically postponed. We call it rolls over. But all that this trick does is it extends the time that you have to pay it. So when the last person dies, the capital gain will still be payable. So it does not take the problem away. We cannot avoid this type of tax, but we can postpone it a bit. Each individual receives 300,000 exclusion at death, and this means if you have a property of 5 million and you bought it for 4 million, so the 5 minus the 4, that gives you a 1 million gain. So everybody gets a 300,000 discount, meaning SARS is kind to ignore the 300,000 and you are just basically taxed on the 700,000. And if you have a primary residence, you're even luckier because then you get 2 million on that property as well. So after determining the gain and deducting any form of exclusions like the 300,000, then for an individual, we usually include 40% of the gain. That's the inclusion rate. And then we use your marginal tax rate to determine the capital gain tax you need to pay. And the bad news is if there's a massive gain, that massive gain can actually go and increase your, put you in a higher tax bracket. And any personal income tax that a person owes SARS should also be up to date by the time the person passes away. So just because you're dead, that's not an excuse for not paying tax. They will take the money from you. And where we usually have additional income tax is also something like movable farming assets, which include livestock or any movable farming implements like a tractor. And if you are registered as a bona fide farmer, that asset will be seen as an income. So what do I mean by that? Let's say you have cattle worth 5 million rand and you pass away. So technically what we are allowed to do is we are allowed to deduct something that we call the standard value. But that standard value is so small that you can basically almost ignore it. Just to give you an example, for a bull, you are allowed to deduct 50 rand. I mean, come on, a bull is not just 50 rand. Okay, so let's say, go back to the example of the 5 million. That 5 million will be seen as an income, even though the person didn't, that is not money walking around there, it's cattle. So it's seen as an income when you die, and on top of your salary or on top of your income, that amount will also be taxed for income tax purposes. So again, here's an example. So here we have 3.5 million of, let's say, cattle. I ignored the standard value because, like I said, it's ridiculously low. So if you have no other income, that 3.5 million worth of cattle that's walking around on your farm will result in you paying almost 1.4 million of income tax when you pass away. Okay, then one of the most well-known costs at death is what we call the executive fees. So on average, it's 3.5% of the gross estate, and that also excludes VAT. Obviously, this amount can be negotiated with certain executors. This is where you pay a person, which is called the executor, to basically wind up your estate. So the executor will go and he will go and pay all your debt and any form of fees and make sure that all the beneficiaries receive what they are supposed to receive. And that's why you are paying him or her a fee, to make sure that he looks at your will and deals with your assets in the way that you wanted the assets to be dealt with. And then the biggest one that everybody always talks about is estate duty. It's actually majority of the estates that I have seen, most people don't have a big enough estate to be affected by this. But if you do have big enough estate, you need to be aware of this. It gets very complicated, so I'm not going to do a lesson here on how to determine estate duty. I just want you to be aware of it. So if your estate is bigger than 3.5 million, this is where you start paying tax. On the first 30 million, you will pay 20% tax, and on any amount above 30 million, you are looking at 25% tax. So I just mentioned that every person gets 3.5 million. The good news is that if you don't use your 3.5 million, you can roll it over to your spouse. So suddenly you upgrade your spouse to 7 million. because what will happen, especially if your spouse starts inheriting a lot of the growth assets, it will postpone the capital gain tax. So this will just at least give you some form of like a buffer to neutralize the effect. Okay, now that I have depressed you with all the stuff that you need to pay at death, I told you I'm going to prove that it is expensive to die. I'm going to look at an example. So this example is Mr. James Bond. He's divorced and he has children and he would like to leave his assets to his children. He only has 2 assets. He has a primary residence, which he bought for 2 million and it's now 5 million. He has a direct share portfolio, which he invested for 4 million and it's now 5 million. So he's left with 10 million that he actually wants to give his children. Then if we go and have a look at everything that he has to pay from funeral costs and everything that I mentioned previously, he almost has to pay just under 2 million to wind up his estate. So at this point, it's just winding up the estate. There's no income left to anyone. So if you have a look at his 5 million share portfolio, that will automatically cut it to 3 million because 2 million of that will go towards cost of dying. Then I said I would have a look at investments at death. So we have different type of investment vehicles which can either fall within the estate or fall without, not within the estate. So how I usually try and remember it is anything that is retirement money, whether it's a retirement annuity, provident pension fund, or a living annuity, that usually is not part of the estate. That falls outside the estate. And then when we look at the executive fees, a way for me to remember it is what will the executor need to work with physically, because he's going to take a fee on that money. So if, like, let's look at an endowment, that's something that it will fall in the estate, but the executor will not necessarily work with it because there might be a beneficiary that's loaded on the policy. And that's also something that only becomes payable at the death of the last life assured. A tax-free investment, you can also load a beneficiary on that. So that forms part of the estate and there's no executive fees payable on that. Why? Because the executor does not get the money. It goes to the beneficiary. The same with a unit trust. Unfortunately, a unit trust, you cannot load a beneficiary. So that is something that will pay into the estate and that will form part for estate duty purposes. And you will also pay executive fees on that specific amount. Then I wanted to touch on some approved and unapproved death benefits because I realized that a lot of the advisors don't really know the difference between the two and what's going to happen when the person passes away. So if it's an approved death benefit, it will basically, the moment that you die, it will increase your retirement money pool. If your beneficiaries take this in cash, they will be paying tax as if the deceased retired the day before he or she passed away, meaning only the first 500,000 of your death benefit will be taxed at 0%. And that's also only if the person didn't take any previous withdrawals. So it's important that you don't look at the death benefit and think that, or assume that this is the amount that the person's loved ones will actually receive. I know at Efficient we have the approved death benefit, so it's important that you understand the difference between these two because it will affect not just you, but also your clients. To give you an example, for an approved death benefit. Let's say you have a 5 million pension, or not a 5 million death benefit, and you pass away. And during your working life, you took about 1 million in cash. I'm not saying 1 million all at once. Maybe every time that you left the job, you took a bit here and you took a bit there, and eventually it came up to 1 million. If you pass away then, and you want your beneficiaries take that 5 million in cash, they might end up paying about 1.8 million in tax. So they will no longer have the 5 million, they will only have 3.2 million. So that's why I'm saying just be aware of the fact that there can be tax consequences on even the death benefits. So for an unapproved benefit, the tax I explained for the approved does not apply. It basically works like similar to a normal life cover policy. And then another big difference is that for an approved death benefit, the trustees will have a look at who is financially dependent on you. And this is usually where the entire family starts calling your employer. Even those relatives whose funeral you've been to at least 2 times, they even call. And then for an unapproved death benefit, that will pay to whomever you decide, and that can also cause a different set of problems, especially if the husband leaves it to his girlfriend and his wife finds out about it later. Okay, so to summarize, I said it's expensive to die, so please don't just try and wing it. Make sure your client has a valid will, and please pay attention when you make investment recommendations because it will affect your client's estate. And please remember to review your client's estate at least once a year to make sure that they keep up with all the costs. Does anybody have any questions?
Hello, Renal. Just check there in the comment section. Cobus asked the question, can you expand on the concept of being registered as a bona fide farmer? What criteria does SARS use to decide if you are a bona fide farmer and not only using a farm as a lifestyle asset?
I'm honestly not sure at what point will it be seen as bona fide farming, but what I do know is you need to register for that. So you can't just say, I have 2 horses, I'm now farming. So you need to be registered as that. So I think that is something where it's no longer a hobby. It's something that you are earning an income from as your main source of income. I'm not sure of the criteria. I can go and check that for you, but I know you need to be registered for that. Okay, let me have a look. Who else asked a question?
You'll see that Carmen asked a question. Can you see the questions on your side, Renal?
Yes, I can.
Okay.
So I see, how is unapproved benefits taxed? Will this be taxed under estate duty? Yes, as far how we deal with it, because it's not a retirement benefit, you usually pay estate duty on it. It's going to depend on who you leave it for. If you leave it for your spouse, then there's that 4Q deduction, so then there's no estate duty on it. So that's one of the tricks that we use, is if you basically leave it to your spouse, then at least you save on estate duty for a while. But that will become payable eventually when your spouse passes away. I'm not sure if that answers the question. Is there any other questions? I don't think I see any other questions here.
Ronald, I just have a question about the income tax liability at death.
Yes.
So my question would be, how would you, as the financial advisor or the financial planner, how would you go about making sure that you have all the relevant information to determine the correct tax liability? And also, would you have to get the help of a tax practitioner, or would you be able to handle the entire process on your own from start to finish?
Well, I think it's going to depend on the type of individual that you're working with. If it's a normal average person that receives a salary, you always pay income tax anyway. So you don't have to worry about that. But it's when you have something, you see, the moment there's something like a business, there's usually some form of a tax practitioner involved in any ways to help you with that. And if it's a farmer, that's where we try and manage it, at least with the farmers, to make sure that they give us the details about what type of movable farming assets do they have? Are they registered as bona fide farmers before we can go ahead? So it's just making sure that you looking at what type of client it is and then asking the relevant questions. In general, I'm not a tax expert especially not with income tax. So if it is a client where the income tax is quite difficult, I will ask the client's tax practitioner. I will usually speak to them and ask them for guidance regarding that.
Okay, thank you.
I see there's another hand, Werner van Heerden.
Ronel, net gou vinnige vraagie. Jy het net nou gepraat van die plaas in die ou wat die klomp beeste en die bulle en goed het. Ek dink nie ek het mooi verstaan nie. Verduidelik net gou weer wat die koste is. Dit estate duty of is dit kapitaalwinsbelasting wat ou daar gaan betaal? Ek dink ek het dalk die bil by die jy weet wat weet.
Is dit okay as ek in Engels antwoord?
Sorry, ja, maak so, geen probleem.
Yes, I'll go back to that one. So I'm just going to go back to income tax. I just want to look for it. Okay. In the past, we had this thing where it used to fall under capital gain tax. The cattle or any livestock used to fall under capital gain tax. But at some point, with the 1st of March 2016, that changed, and they changed it to that it falls under the income tax. So if you have cattle, let's say you have a different type of cattle, you look at the livestock value as well as any tractors. So it has to be movable farming assets. I'm not talking about buildings and things like that. You will look at the value, and then there's usually a publication with that shows you, let's say for a cow, you can deduct 50 Rand. So for different animals, they have different values per animal that you can deduct. But usually I struggle and get this information from either the advisor or the client themselves. So then I just ignore the standard value because it's so small that it doesn't make a difference. And then I go and have a look. Okay, this is the amount that will be taxable. And you have, and I have a look at what income does this person get if I ignore the whole cattle thing, because that amount is going to be on top of that. And usually I make provision for that on top of it. I'm not sure if that clarifies it. So this is basically treated like an income when you die.
Okay, Ronel, so if I understand it correctly, let's say the farmer earns 4 million Rand a year. Then the value of this livestock of 3.5 million Rand will then be added to his 4 million, which brings it to 7.5 million. And obviously he will then be paying tax accordingly as per the tax tables.
Yes, so it pushes him into a higher tax bracket. If it's going to probably depend on, yeah.
Another question is you mentioned, let's say a guy buys a stud bull, for example, and he pays 1 million Rand for the bull, and yes. That is obviously a base cost. I would refer it to. I don't understand exactly how that will impact it then.
So no, there's no base cost anymore on this because it's that was how it was treated in the past. So if it was a cow and he paid 1 million Rand, I'll open my calculator to show you. 1 million Rand, and we're allowed to deduct 50 Rand, and that's why I'm saying you can just as well leave it. So on that bull, he can potentially pay 450,000 just on tax when he passes away.
Thank you. That makes sense. Shocking, but it makes sense. Thanks.
I think that is why a lot of people move their farming assets into either a trust or a company, so that can be, I think, treated differently. Okay, that was Werner's Skalk.
Well done, Ronel. I found this very useful. Just a comment before my question. If it's a blow bull, it should be much more than 50 Rand. But anyway, please explain the difference between transfer fees and transfer duty.
Well, how I usually make sense for myself is usually when you go and buy a property. like let's say I want to go and buy a property, I'm going to pay transfer duty and transfer fees on both of them. So it will be both of them. So the transfer fee is the smaller one. It's basically just to register the name. I'm honestly not sure why it works that way, but it works that way. So it's when you pass away and you leave it to a beneficiary, you don't have to pay the transfer duty, just the transfer fee. I'm not sure if that clarifies it. I just know that that's how it is.
Just one other comment, and just thinking about, this has been very useful to highlight the hoops that we all go through on death. The fact finds that we have, are they sufficient to pull this out? Or do you have more specialized fact finds when we, for example, dealing with a farmer or divorced person who's got two ex-wife, et cetera, do you get enough information from what we've put together, or is there an opportunity to drill down a little bit further to help you get more accurate information?
So at this point, we only have the normal estate planning template, but usually if I notice that we're looking at farming assets, I will start asking questions. So you are going to get an email with questions. I need this, I need that. And I usually then, where possible, ask them for some form of statement so that to try and help me to make sense of it. Because with the farms, it usually gets very complicated. At some point, I can see that perhaps we should look at having a capture form for farmers specifically for estate duty. That's something that we can definitely look into.
Ronel, can I maybe just make a quick comment on the transfer fees? Is that, and sorry, I didn't follow the entire presentation, but transfer fees, that's what gets paid to the lawyer. So you need to be a conveyancer to transfer property. So the lawyers obviously get paid, and that's exactly the same with the bond cancellation fees. Yes. So that's professional fees for the attorney or the conveyancer that's responsible for the bond cancellation and the transfer of the property. And then transfer duty is obviously the tax.
Okay, thank you for that, for clearing that up. I wasn't actually quite sure, but I do know that when it comes to leaving it to beneficiaries, it's treated differently.
Yeah.
Okay, and then Yaku. Oh, he's a tax expert. Now I'm very nervous.
I don't know. Yeah, I just wanted to quickly clarify for you guys on the farming registration. So it's not required for the Income Tax Act to be registered as a farmer to be able for it to be applicable. So in your individual, if a farmer is trading in his individual name, the only thing that dictates if he's a farmer or not is the intention to farm. That's dictated by the first schedule and section 26 of the Income Tax Act. So the only place where a farmer needs to be registered is for VAT. He needs to be specifically registered as a farmer. And that's why most guys normally, as the farm, if your turnover is above 5 million, they'll normally transfer it to a company and the assets to a trust to make sure that all of that admin and stuff gets sorted out. So, yeah, I hope that helps. There's a very, very nice discussion piece on it on the SARS website. So if you just search for farming SARS, you'll find it.
Thank you, Yaku. Maybe I can ask you this. How is it treated, like if somebody has a guest house and they have do farming on the side? Because you're talking about intention. If the intention is to do that as a secondary function, will that still be seen as farming?
It will still be seen as farming. The ring fencing provisions will make sure that the deferred loss or profit from that specific farming will then only be captured for that. So only taxpayers that are on the maximum tax bracket will get past that ring fencing provision to be able to deduct losses from farming from their taxable income.
That makes sense. Thank you. Okay, does anybody else have a question that I've missed? I still see Werner and Skulk's hand being up, so I just want to make sure that they don't have any more questions.
Sorry man, ek weet jy moet afhaal nie, maar jy kan verder hier, so jy kan myne afhaal.
Okay, great. Then if we're done, I want to thank you for joining me in this presentation, and I hope you have a fantastic day.